Hello everyone, welcome back. And this is a major update to our ongoing macro discussions. And there's been a couple of surprising things that happened last week, so I want to get everybody up to speed on what happened and how that is impacting my thinking with regards to how I've been viewing the economy in general and the trends that have been developing in three major categories. So let's get started. There's a lot to get to. But basically, in a nutshell, I want to first start off because there were some massive, very, very significant revisions that came with the GDP report that we got last week, and it surprised to the upside. And so a big part of the bearish thesis that I've been actually putting forth actually got upended just overnight last week. So let's talk about what happened and what that implies. So to recap, I've been talking about three major risks that have been forming that I believe are currently underway. One is the job market that is sending recessionary undertones, and we'll look at a few more of those charts to show exactly what I mean by that. Market valuations are at extreme levels. We're currently trading at 22 times forward earnings estimates, and that ranks in the upper quartile. So the upper 25% of all observed PEs going back 35 plus years. So valuations are extended, which means that a lot of optimism surrounding the soft landing is priced in my view. If we were to take history as any precedent, valuations are stretched, and so a lot is being baked into equity valuations today. And at the same time, we have consumer finances that are stretched thin and hitting levels of distress. So these are the top three areas that I've been talking about that are very, very dangerous, given the fact that we are at very high valuations in the equity markets. However, number three there got a big revision. And so in a shocking development last week, when we got the Q2 GDP report, remember the BEA goes through two iterations. First is the initial estimate. It goes through one iteration, and then it goes through a second iteration, meaning that's basically the third estimate for GDP. And the first two estimates were, basically not really different. And then the third estimate brought in huge revisions to some very key data points that I've been talking about for many months. Real disposable personal income, DPI, that's the amount of money that people are taking home at the end of the day, the amount of money that people have that is available to spend in the economy. That was revised up by a staggering 1.4 percentage points. So that means that the growth in DPI went from a 1% growth quarter over quarter to now 2.4% growth quarter over quarter. This is substantial because this takes us back to long-term trend growth in DPI. Remember, a big part of the bearish discussion was that real disposable personal income was well below trend. If we were to go back 10 years, taking the growth trajectory of the 2010s bull market ever since COVID, and therefore the huge burst of inflation that we got after that, real disposable personal income was well below trend. And so I was using that as a big part of my bear thesis because spending has been happening in excess of income, and that is never sustainable. You can't be spending in excess of income in perpetuity. And that was a big reason why I was bearish on retail sales and personal consumption. But with this revision, real DPI is back to long-term trend growth, which is very surprising and bullish. Personal savings, as a result of this, was basically almost doubled overnight. It went from 598 billion to 1.05 trillion. So that is a much bigger savings rate than what we previously feared. The personal savings rate was revised from 2.9%, which was a multi-decade low. This was a reason why I was getting very cautious, because we were seeing rising unemployment from a very depleted personal savings base. Personal savings was at lows, as well as the personal savings rate was dangerously low at 2.9%. That was the second lowest personal savings rate in 2 decades, going back to 2004, when the lows were at 2.4%. But now that was revised to a much more respectable 4.8%. And that puts it basically in line with where we have always been throughout the 2010s, during which we were in a bull market. The savings rate was at, I want to say actually around 5.5%. So 4.8% is still low, but it's nowhere near dangerously low as what we previously feared. And remember, all these numbers were revised overnight last week. So again, prior to this revision, personal expenditures, that's PCE, right? A big part of GDP, basically 65% of GDP. Personal consumption expenditures had been growing faster than real disposable income. And that can't happen. That can't happen forever without drawing down on savings. And that's what was happening prior to this revision. And that's what led to that multi-decade low in the savings rate, and puts the current pace of spending at severe risk, right, as unemployment makes its cyclical upswing. That was what I was, very, very concerned about for many months now. But this is a very large and shocking upward revision. And since it now puts it back to long-term trend growth, and since personal savings rates are back to normal levels, this suggests that the consumer is in a much stronger position than what I originally feared. And here's a chart of that. You can see that the black line shows the real disposable personal income after the revision, and the red dotted line shows how it was just about a week ago. 1 week ago, we were at a much lower personal income base. And now that revision upward really, shifts the entire trajectory upward and basically puts it back to trend. If you were to draw basically a straight line throughout the 2010s bull market, prior to this revision, we were actually at below trend. If you just were to imagine a trend line here, and extend it outwards, we were well below trend, and that was what was concerning, because PCE was very, very strong, which tells me that people are dipping into their savings, they're dipping into credit in order to continue the pace of spending. But now with disposable incomes shifted upward, we are significantly better than what I previously feared. So that's, did a pretty much a big, upswing to the personal savings base. We were at $598 billion before this revision, which happened a week ago, to now well over $1 trillion. That's almost a doubling in the personal savings total. And the personal savings rate, which tells you and puts everything into context, this is basically now back to, normal levels, 4.8%. That's where we've pretty much always been for the better part of the last 2 decades, plus or minus a percentage point. But we were at dangerously low levels at 2.9%. That was basically the third lowest observation in the last 20 years, which again puts things at risk, because if unemployment is about to swing up, and if people don't have much money saved, that puts them in a very vulnerable position. But at this point now, with the revision, things are much better off than I feared. Also, GDI, I've been talking about this for a year now. Real gross domestic income, which never gets any discussion. Nobody talks about GDI, but GDI is the other half of the equation of GDP. GDP is what gets all the airtime. But remember, GDI is the income side of the equation, right? GDP measures consumption, and GDI measures income. So they're basically equivalent. They have to be equivalent because if I buy something, GDP measures what I paid for, right? Consumption. But GDI measures how much income the recipient received, right? So they're supposed to be the same. What I paid for should equal what the business that I paid receives, right? So they're supposed to be equal, and they are equal for the most part. You can see this chart going back 70 years. It pretty much, hugs this, somewhere between 0.99 to 1. You can see that most of the time we spend in that range. The ratio of GDI to GDP is really not really disconnected by much more than 1%. But look what's happening here. We are now well below 2% of a deviation, and that never happens. You can see that going back 70 years. We never see GDI drop that far below GDP unless if we are in some type of period where GDP has to be revised lower because of recession. And we saw that happen in 2008. We saw that happen in 1979, just before that recession. The only exception was this period right here, 1994, 1993. But then we saw that furious upswing during that bull market in 1996 to 1999. But this is usually not something good to see. And this suggested to me that GDP was at risk of being revised lower because it's been undermining GDP for 7 consecutive quarters. This is a typo. I went back and checked. It was, well below GDP now for 7 consecutive quarters. That's never supposed to happen. But look at now. Here's the before and after. This is the before. And just keep an eye on this part of the chart right here because that's what gets revised. Stuff doesn't get revised, 10, 20 years later. It only gets revised, up to a couple of years from the present. So just pay attention to this part of the chart, all the way to the right. Bam. Look what happened there. Complete reversal of what, I was fearing in the past. Now, real gross domestic income is basically in line with where it always is during normal periods of economic expansion. That is a big change. So again, prior to last week's revisions, real GDI growth had been significantly below real GDP for, again, 7 consecutive quarters, not 6, but 7. But now after the revision, the BEA now states that real GDI has been growing faster than real GDP for the past 2 quarters. So this upward revision is significant since the ratio of the two has historically provided a meaningful clue that the business cycle is about to turn. And with last week's revision, this is no longer the case. Here's a quick table that summarizes the results. The upper part of this shows what happens after the revision. It's been below GDP for all of this time, from Q4 to Q4 of 2023. For a whole year, it was below, and now look at the revision. GDI is now growing faster than GDP for the last 2 quarters. This is what it was before this big revision. We were well below GDP for 7 consecutive quarters. So this is a material change here. Again, prior to this revision, personal consumption had been outpacing disposable income. With DPI well below trend, that is not a sustainable trend. Spending in excess of income is not sustainable, which is why I was bearish on retail sales going forward. However, with that revision last week, this is no longer the case. Incomes are now actually growing in line with spending, which is amazing. But despite this, I still remain cautious because I still wonder if incomes, if consumers are still flushed with cash savings driven by income growth, then why are loan delinquencies rising rapidly and now at levels consistent with the last recession, the great financial crisis of 2008 to 2010? Why are loan delinquencies back to those levels, and why are real retail sales still flat? real retail sales are still flat for the last 3 years and even over the past 2 years. There's been no growth in retail sales after adjusting for inflation. So why would that be happening? You can see here a chart. This is from the New York Fed. Credit card loan delinquencies and auto loan delinquencies. This is the dark blue line and the green line. These are rising sharply and back to levels that we haven't seen in 13 years, going back to 2010, 2011. Here you can see for credit card delinquencies going back to 2011. Why would this be happening if incomes are, sound? If incomes are back to trend growth, if personal savings is back to long-term averages, why are delinquencies so high and rising? Also, you can see from an earnings standpoint, consumer discretionary, the sector of consumer discretionary, earnings forecasts continue to be revised down by not an insignificant amount. Over the past year, earnings estimates for the average consumer discretionary company has been revised down by 18.3%. And those revisions actually took a turn for the worse in just the last 2 months. And this is the upper panel, which represents fiscal year 2024. The lower panel represents fiscal year 2025. Those revisions are also being marked down sharply by about 14% over the past year. This is not a good overall trend. So changes in consumer behavior are getting noticed in both the August and September ISM manufacturing surveys. Surveys with respondents have noted a significant slowdown in consumer activity. You can pull it up directly. I highly recommend reading it. If you just go to the ISM website, just search ISM manufacturing and go to the ISM website and read the latest September ISM manufacturing report. And if you scroll down and just go beyond the numbers and read the anecdotes, anecdotes are very important to use, as a confirmation of what you're seeing in the data. And, the survey respondents, these are managers, these are executives of manufacturing companies, factories, that are telling you how things are going with their respective businesses. And a greater and greater portion of survey respondents have started to comment that they are noticing a significant slowdown in consumer activity. You can read that for yourself. Here is a chart of ISM new orders minus inventories. And as you can see, this number plunges only in recessions. And with the exception of 2015, right? That's the only exception. We have never seen this number be negative outside of recessions. Again, only 2015 being the outlier there. So maybe this time is like 2015, but if you use this in combination with everything else that we've been talking about, like consumer loan delinquencies and like jobs, like we're about to see in a second here, this is not it's not painting a bullish, picture. ISM manufacturing is now in contraction for 22 out of the last 23 months. That's never happened, outside of recessions. And you can see this is the reason why this is important is because this has a very strong leading correlation to forward earnings expectations for the S&P 500. And with ISM remaining depressed now for an extended period of time, you can start to see that this upward revision, which, was within the context of this upswing that we saw in the ISM, is at risk of rolling over the longer this remains in contraction. And that's what we're starting to see here now. There's still a lot of optimism. You can see that the forward earnings growth expectations are strong still at 9.9%. That's very bullish. But the longer this remains in contraction, remember this has a forward sort of a leading edge to earnings estimates. And once again, for the September reading, we got another bearish print, another contraction. So again, I believe that the longer this remains in contraction, the greater the risk of S&P earnings are, and that's what typically commences, big market downturns. The job market has been consistently deteriorating for 12 months now, and it really accelerated in July. You can see here unemployment claims plus part-time job holders for economic reasons, that crosses a recession threshold. A lot has been said about unemployment claims. People, the bulls say that, unemployment claims are very, very low, which is true. But if you combine that with part-time job holders for economic reasons, these are people that are working part-time because they're forced to. People that have reported that they would rather be working full-time but simply can't find full-time work, so they are forced to work part-time. This is kind of an unemployment proxy because, although they're not truly unemployed, they are holding a part-time job. But they are underemployed. And so when you are working part-time, that automatically disqualifies you from being eligible for getting unemployment benefits. So it's actually important to combine the two for analytical purposes. And you can see here on the chart, every single time this series, the sum total between continuing claims and part-time job holders for economic reasons, the sum total of that, whenever it crosses above its 36-month moving average, as you can see in the blue line, we have been entering a recession. And you can see that the crossover happens right at the start of recessions with, beautiful accuracy. You can see the shaded regions are the official recessions, again, which are always declared in hindsight. So you never truly know we're in one until much later, but you can see these numbers happening in real time. So this crossover happened right before that 1974 recession. This crossover happened right before the 1979 recession, which really carried through for a number of years. This crossover happened right before that 1991 recession. Crossover again right before the 2001 recession, right before the 2008 recession. This was not a true recession, right? Because that was a forced lockdown. So there was no reaction time, for anybody to react to in advance. But now you are absolutely getting plenty of time to react to this. And we're once again crossing over that recession threshold. Again, the recession threshold that has worked consistently with no false positives going back 60 years. Very, very convincing. Same thing goes with the unemployment rate. That crosses, the same recession threshold, which is the 36-month moving average. Every time the unemployment rate crosses above that moving average, we've actually been within recession. So this is actually slightly lagging in that sense, which actually tells you an even worse story now, because now that we've crossed it and cleanly crossed it, this means that we could be in a recession right now. And we just don't know yet because the coincident data has not yet confirmed it. But remember, those data points are always confirmed in hindsight. It's never in real time. So we have to rely on leading economic data to get it right before the coincident data starts to confirm it, because by the time the coincident data starts to confirm it, the market has already realized that and is heading lower substantially, well in advance of that. So this is a warning shot right now. Between this series, again, which has had a flawless track record at predicting recessions in advance, going back 60 years, this is also confirming it as the unemployment rate, crosses that, its own recession threshold. The broader unemployment rate, which is also very important, this looks at total unemployed plus the total underemployed, which is that series that I mentioned, the people that are working part-time for economic reasons. So if you look at the total underemployment rate, that's the U6 rate, that has crossed its recession threshold in 2000. Unfortunately, we don't have more history on this, but with whatever we do have, this crossover happened during the thick of the dot-com bust. This actually happened in advance of the 2008 crisis, and now once again you're seeing a clean cut through the moving average again. Remember, unemployment happens in momentum. As we start to see people get laid off. Even though layoffs are low, that's how recessions always start. In the first quarter of recessions, layoffs are always low, and then it builds and builds over time. The U2, which looks at specifically layoffs, this is the strictest definition of unemployment. This has not yet triggered a recession because you can see it has not yet crossed that threshold. The threshold right now stands at 2.1%. Right now we're at 2%. But you can see the trend is very clearly up. We might even cross over it once we get the September jobs report coming up this week. We will see. But you can see here, going back decades, 50 to 60 years, every single time this series has crossed over its moving average, we have already been in recession each and every single time that has happened. Some of them have actually happened in advance of recessions. Others have happened in the middle of recession. So whenever it does happen, again, because it's never had a false positive going back 60 years, if this does happen, again, this is yet another indication that we are once again entering a recession. Also, the quality of the job market has diminished greatly. 61% of all jobs created over the past 12 months have came from government or government-adjacent industries, meaning healthcare and education. Household employment level is officially in contraction, and the trailing 12-month job growth has been revised lower by 20%. That's minus 450,000 jobs. We'll just take a quick look at each one of these here. So, on the first point, the true private job market, meaning total non-farm payrolls minus government, minus education, and minus healthcare. You can see I've listed it out here. So I define the true private sector as, all jobs minus government jobs, minus education jobs, and minus healthcare jobs. Why do we do that? Because healthcare and education are, you can make the case that these are government adjacent industries because they receive direct funding from the government. Like for example, Medicare essentially supports 90% of the healthcare industry. The Department of Education supports a big chunk of education jobs. Also, state governments support a big chunk of education jobs. In fact, that they support a majority of education jobs. So again, these are government adjacent industries. Not saying that they're not good jobs. Obviously, healthcare jobs can be very, good, well-paying jobs. Not saying that. But what I'm saying is, for analytical purposes, removing these three sectors gives you a more cyclical look at the job market. And as you can see, collectively speaking, non-farm payrolls, excluding these three sectors, never really go into contraction, with the sole exception being that brief period in 1989. As you can see, it went into contraction there. But with the exception of that one time, we have never seen this series go into contraction. And right now, the collective true private sector has only created 35,000 jobs on average over the past 3 months. That is the slowest growth of any bull market in 40 years, again, with the exception of that one time there. And that happened for just a month, and then it bounced right back. But this is the slowest growth of true private sector jobs we have seen outside of recessions. Government sector job growth is sharply outpacing the true private sector. As you can see, look at the spread between the two. This teal line is government jobs, and the black line is the true private sector jobs. This is year-over-year growth. And again, this is the slowest pace of growth. This is now at, growing at just 0.8% year-over-year. You can see that it's never this slow outside of economies that are transitioning into recessions. So again, the share of government, meaning government, healthcare, and education, has on average been about 15 to 25% of total job growth during every period of economic expansion going back 70 years. So again, there's always government, healthcare, and education, but on average, it's only been 15 to 25% of total job growth. every single time that the share of these government jobs has crossed 60%, we have entered recession within the next 12 months, every single time with 0 false positives. And we're currently at 61%. So again, this is very substantial data that we can't ignore. The household employment level, this almost never gets talked about, but this surveys employment and unemployment based on surveys of households directly. Whereas the number that you usually see is the number that is surveyed by businesses. Households are reporting a decline in employment now for the first time this entire cycle. This never happens. As you can see on this chart, the household survey of employment never goes into contraction on a year-over-year basis outside recessions in 70 years of data, going back to the 1950s. Every single time this goes into contraction, we have been in a recession. These areas aren't shaded because we actually don't even have the recession data going back to the 50s. It really starts in the 60s. But you can see here, every single time it goes into contraction, we have been inside of a recession already. As you can see, when it crosses that zero bound, we've already been in recession. But again, we don't know it until much later because, again, recessions are always in hindsight. It's always declared later that, oh, by the way, the recession started 6 months ago. Oh, by the way, the recession started 10 months ago. That comes out much later from the National Bureau of Economic Research. So we usually don't know it until we're in it. But here we are in contraction, not by much. It's only a decline of 0.4%. It's really not a lot. But again, it never goes anywhere close to zero unless if we are entering or in a recession, and that's where we're at right now. Gold has been on a tear. Gold has actually outperformed the S&P. Year to date, it's outperformed the S&P over the last 2 years as well. Despite the incredible bull market we've been in for the S&P, this could actually be signaling a recession as well because gold has an inverse relationship with the fiscal deficit. This is a remarkable inverse relationship here, a 74% negative correlation between the two, as you can see on the chart. And the deficit has really exploded. The current deficit over the past 12 months through August is $2 trillion. It's north of $2 trillion of a deficit. So as you can see, every time the deficit gets worse, gold goes on a major rampage. And every time, the deficit gets trimmed, meaning the U.S. government's finances are getting in better shape, gold goes into hiding. It goes into a bear market. So we saw here during the 2013, 2014, 2015, the deficit really narrowed as the economy exited recession and GDP got, gained strong. And the deficit was able to be trimmed from a nosebleed 1.5 trillion as a result of the aftermath of the great financial crisis to something a lot more manageable, 500 billion. As a percentage of GDP, that was very small and manageable. So gold went into, a deep bear market. But since then, you can see that the trend has been very, very bearish for the deficit. Government spending has outpaced tax revenue significantly. And it got really bad as, during COVID, as we all know. But it had a major bounce back, as you can see here, as we exited the pandemic and went back to work. The deficit was trimmed from a unspeakable $4 trillion, which is ridiculous, to $1 trillion, which is still bad, but trending better. But now, since that time, you can see that government spending has once again exploded in the last 2 years, and that is when gold has made its parabolic move upward. However, the deficits can get bad for either of one of two reasons or both. Government spending outpacing tax revenue, or tax revenue going down. And when does tax revenue go down? In recession. So this explosion in the price of gold could be an anticipation that the government is getting ready for another major round of fiscal stimulus, or the explosion could be that we're about to see a big decline in tax revenue. And tax revenue declines are typically associated, in fact, only associated with recessions. And so that is what could be in the forecast for gold. And that's why the deficit could be in very deep trouble here, about to head down substantially further if this relationship continues to hold, which it has for the last 40 years. So again, this is yet another possible confirmation that gold is sending a signal that liquidity is too great and that the deficit is at risk. So again, putting all this together, either we're getting ready for an epic deflationary productivity boom in which prices are down, employment is down, but production is up thanks to AI and other technologies, or we are entering a classical recession. One of the two have to be happening. Now, S&P 500 forward PE is at 22 times. That ranks in the upper quartile of all observed forward PE multiples in the last 40 years. This means that growth and optimism is priced in. A soft landing thesis is fully priced in. So if we don't get that AI-fueled productivity boom, and instead slip into that classical recession, which is the other scenario, then the downside risk is tremendous. But the upside risk is limited because we're already at very, very elevated forward PE multiples. Not a trailing PE, but forward PE. This is a high PE multiple on bullish earnings expectations. So as such, the risk reward, in my view, is substantially skewed to the downside. And so this is the reason why I've been pounding the table on the Zacks Earnings Certain proxy. This is the portfolio that I directly manage. This is a collection of the best, the highest quality, recession-resistant, durable moat protected, low volatility, steady compounders. These are companies that are performing well in every environment, whether bullish or recessionary. And it's driven by the 4 pillars of quality. We build this portfolio with these 4 factors in mind: earnings stability, earnings growth, return on invested capital, free cash flow conversion. These are companies that have withstood the test of time and have an ability to grow even through recessions. As you can see here, these are just 4 examples of companies that have sustained earnings growth even through recessions or through bull markets. It really doesn't matter what's happening. These companies continue to execute flawlessly and have demonstrated an ability to do so for decades now. And again, it's built for long-term durability. This is the portfolio as an aggregate. You can see how stable the earnings growth has been for these companies throughout bullish and bearish markets. And we believe that this is the ultimate portfolio for long-term value creation. So again, we'd love to hear from you on any of these charts and slides that I presented. Love to hear any feedback, positive or negative. I'd be all ears. Please do reach out to us. You can reach us at 1-866-794-6065 or shoot us an email at strategycall@zackspro.com. All right, everybody, talk to you soon on the next strategy session. Take care, everyone. Bye-bye.